Economics A level. Today's topic is profits and loss. So when we talk about profit, basically we're talking about total revenue exceeding our total cost. That is a simple definition for profit. It means your total revenue exceeds your total cost. And what is your total revenue? Your price multiplied by the quantity. And your total cost is the combination of the fixed and the variable cost. So we'll go further by reading, then I explain more. Profits and losses. So we'll go to profits. Profit is the difference between revenue, the receipt of the firm, and cost, cash paid out by the firm. So the receipt of the firm is the amount of money received in terms of revenue during the course of selling. That is receipt. That is what we call revenue. Then the amount being paid in the course of producing such goods, or in the course of purchasing those goods that are being sold, is called cost. The amount being paid when those goods are being purchased before selling is called cost. So a firm will make maximum profit when the difference between the total revenue and total cost is greatest. Now, we are moving forward by talking about maximum profit. When it is maximum profit, it is not profit. Maximum profit simply means that your total revenue exceeds your total cost at the greatest opportunity. That means you are able to make the highest possible profit within the industry. That is what maximum profit is. I go further. In table 1, total revenue is shown in the second column. This is the second column, total revenue. The second column, while total cost is in the third. This is the total revenue, this is the total cost. Profit is different between the two. So our profit is total revenue minus total cost. Our total revenue, TR minus TC, gives us profit. So profit or loss is total revenue minus total cost, TR minus TC. Where TR is price multiplied by quantity, and TC is FC plus VC. So we check. For our profit here, we have our total revenue to be 25, our total cost is 35. So 25 minus 35, that's a minus 10. So our profit here, which is not a profit anyway, it's a loss. But we're not going to call it loss here because we are still dealing with profit. So here we have a negative 10. Total revenue minus total cost is a negative 11. Total revenue for column 3 minus total cost is 0. So here, our total revenue cost our total cost. So we call that break even. So that means we neither make a loss nor a gain. So TR minus TC equals to 0. Now our TR minus 90, our TR minus TC here is 10. So a profit of 10 is made here. A profit of 19 is made here when you find the difference between the TR and the TC. The TR and the TC makes a profit of 27. The TR and the TC make a profit of 18. The TR minus TC makes a negative profit of 4. So this is the difference between total revenue and total cost. So your profit is always what? TR minus TC. So we move further. So we're going into different types of profit we have. So here we have normal and supernormal profit. Why do we call it a normal profit? So what we call it a normal profit because based on economics, a normal profit is that profit that you are supposed to make if you have used your resources to produce the next best alternative. So I'm going to read anyway so that we can get to understand more. Cost. Okay, so normal and supernormal profit. Cost for an economist is different from that of an accountant or business. The economic cost of production is its opportunity cost. So the cost of production or the cost is different. Cost for economists is different from cost for a business person and an accountant. Cost for a business person or an accountant is the cost of production, but cost for an economist is the opportunity cost, which means the next best alternative that is forgone. So the amount that we're supposed to have made if we have used the resources to produce the next production would have been our opportunity cost. That is what they're talking about here. So the profit that we are supposed to have made if we have used the resources to produce the next best production would have been our normal profit. So let's read anyway. So the economic cost of production is its opportunity cost, like I said. It is measured by the benefit that would have been gained if the resources employed in the production process had been used in their next most profitable use. So if the firm is in between making a manual calculator and a scientific calculator, so the firm carried on and produced a manual calculator. And in the course of producing the manual calculator, they get to realize that the production of scientific calculator would have given them additional profit. So that profit that is lost by not producing scientific calculator is called the normal profit. I think we understand what normal profit is now. So normal profit is the production that would have been made to have made certain profit if the next production has been made, if the next alternative that is foregone was used in terms of production. So we are supposed to make a manual calculator, but we did not make we're supposed to make a manual calculator, which we made. But if we had made a scientific calculator, we would have made more profit than making a manual calculator. So the profit that we didn't make in the cost of producing a scientific calculator is called the normal profit. I think normal profit is clear. Then, they said if a firm could have made 1 million, yeah, there's an example already. If a firm could have made $1 million profit by using its resources in the next best way, then the $1 million profit is an opportunity cost for the firm. In economics, this profit which is counted as an economic cost is called normal profit. So, like I just said, the $1 million that would have been made in the next best production that was not made is the normal profit. Then, if the firm failed to earn normal profit, it will cease to produce in the long run. The firm's resources will be put to better use producing other goods and services where a normal profit could be earned. So, as a firm should always think ahead. A firm should always think about making normal profit. Because if it doesn't think about making normal profit, it means resources are not efficiently used. It means they are wasting resources and they cannot last. So in the long run, a firm is likely to shut down because it's not using its resources in the best possible way. Because we have the resources to produce manual calculator, we have the same resources to produce scientific calculator. After producing manual calculator, we get to realize that we should have produced a scientific calculator which would have given us more profit. So if we continue to have regrets about what we produce, then in the long run, we cannot survive. We won't be able to continue existing. So a firm must always use its resources judiciously in the most efficient way to be able to make normal profit. That is the point there. So instead, the firm's resources will put, okay, yes, we talked about that. Hence, normal profit must be earned if factors of production are to be kept in their present use. In essence, it is the minimum return on an entrepreneur will be willing to accept to remain in the current business. So, if a firm, as an entrepreneur, you are supposed to be aiming at maximum profit, or you are supposed to be aiming at normal profit. But if you are unable to use your resources efficiently, judiciously, then you won't be able to get the normal profit. But as an entrepreneur, the minimum return on your investment should be making normal profit. That is the point there. So normal profit is what a firm should always be aiming at. Then we have the supernormal profit. Why do we call it supernormal profit? Supernormal profit, also called pure profit or abnormal profit, is the profit over and above normal profit. In essence, the profit over and above the opportunity cost of the resources used in the production by the firm. It is important to remember that the firm earns normal profit when total revenue equals to total cost. However, total revenue must be greater than total cost if it is to earn a supernormal profit. So, our normal profit occurs when our total revenue exists, when our total revenue equals to our total cost. So we didn't make a loss nor a gain. That is a normal. That's a normal profit. But if we are to make abnormal profit or supernormal profit, it means our total revenue must exceed our total cost. That is how to earn supernormal profit. I think normal profit and supernormal profit is clear. So we have. So let's quickly go down to, let's see, profit maximization. So that's about normal profit and normal profit and supernormal profit. So we go to profit maximization, where we're going to stop for today. So for profit maximization, in some of our previous classes, we talked about profit maximization, which must occur when our marginal cost equals to our marginal revenue. So let's read anyway. Profit maximization, the MC equals to MRO. Marginal cost and marginal revenue can also be used to find the profit maximizing level of output. What's our marginal cost? Our marginal cost is the cost of producing additional unit of output. The cost incurred in the cost of producing an extra unit of output is called our marginal cost. Then our marginal revenue is the revenue that we are able to get in the cost of selling an extra unit of output. So the increasing the extra unit, the revenue made for selling an extra unit of output is called marginal revenue. So here we have, we talked about it in Swim Book 1. Then we have, let's see. So they said, okay, The third unit, okay, that's about student book 1. So I'm just going to use this case study to explain further. Here we have our output, we have our marginal revenue, which is the extra revenue made in the cost of selling additional unit of output. Then our marginal cost, that's the cost incurred in the cost of producing an extra unit of output. Then this is our additional profit. How do we get our additional profit? Our additional profit is derived from taking away the difference between our marginal cost and our marginal revenue is the additional profit. Because here we're talking about additional cost and additional revenue. Additional cost and additional revenue. So our additional cost is our marginal cost. Additional revenue is our marginal revenue. Additional cost is derived because of extra units produced. Additional revenue is derived because of extra units sold. That is, so the difference between marginal revenue and marginal cost and marginal revenue gives us our additional profit, which is the total profit. So here our marginal revenue minus marginal cost is minus 10, MR minus MC, 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 MR minus MC. So this is how we got our additional profit. Then we go further with this activity, then we stop our class for today. So here we have this activity. They said we should calculate the maximum profit. How do we get our maximum profit? Before we get our maximum profit, we need to understand our total profit. And what's our total profit? Our total profit is always total revenue minus total cost. So 10 minus 8 million, that's 2. So our total revenue, total profit here is 2 for column 1. For column 2 is 20 minus 14, which is 6. 30 minus 20, which is 10. 40 minus 30, which is 10. 50 minus 50, which is 0. 60 minus 80, which is minus 20. This is our total profit. Now we go to our marginal revenue. For our marginal revenue, to derive our marginal revenue, it is TR2 minus TR1. TR2 minus TR1. Our total revenue 2 in the column 2 minus total revenue in the column 1 will give us our marginal revenue. So our first marginal revenue will be 20 minus 10, which is 10. 30 minus 20, which is 10. 40 minus 30, which is 10. 50 minus 40, which is 10. 60 minus 50, which is 10. So this is how we derive our marginal revenue. Then our marginal cost will be TC2 minus TC1. Our marginal cost will be TC2 minus TC1. So TC2 is 14 minus 8, which is 6. 20 minus 14, which is 6. 30 minus 20, which is 10. 50 minus 30, which is 20. 80 minus 50, which is 30. So this is how we derive total revenue. This is how we derive our total profit, our marginal revenue, and our marginal cost. I'm going to quickly explain again. To derive our total profit, it is TR minus TC. To derive our marginal revenue, it is that's MR. MR is TR2 minus TR1. And for MC, it is TC2 minus TC1. Thank you once again. So that ends the lesson about profit, supernormal profit, normal profit, maximum profit. Thank you.